I'm Greg Hunter. Welcome to USAWatchdog.com. With us a guest we haven't had on probably for a year. I remember reading this gentleman back when I was at CNN back in 2005, and he had a very good, and still does, a very good website, rickackerman.com. Rick Ackerman coming to us from Colorado. Thank you for joining us today on USA Watchdog.
Thanks for having me on, Greg.
I just love your thing. I love, you came out, you're a prolific writer. You wrote all the time. I loved your Rick's Picks, which is fabulous. And you have some strong predictions for 2015. And one of them, let's just get right in there. Your predictions, you gave brackets. This is the bullish prediction. This is the bearish prediction. This is the middle. And I want to start with interest rates. You're thinking the 10-year Treasury is going to go below 2 and stay there. Why?
Yeah, I'm looking at a bull market that's been going on for more than 30 years, and I think it's going to continue. My perspective is that of a deflationist, and it's been easy for me to see that even though we have inflation in certain things, certainly food prices, college tuition, the much bigger picture is one that's deflationary, and it is that huge quadrillion-dollar derivatives edifice that the central banks are all fighting to keep from imploding. So I'm a deflationist, and I see rates coming down. My projection for the 30-year is 1.74%. And keep in mind that anything that you do with long-term, if you're at the long-term, at the long end of the yield curve, you're tremendously leveraged with respect to capital gains. And last January, when I told all my guys to jump into long-term T-bonds, I mentioned that the potential capital gains were as high as 40% in that trade, because the further you go out in time, the more of a gain you're going to have in these instruments that trade here and now.
Well, it looks like you were right. When you told people to get into the 30-year Treasury, or I guess the 30-year, or the 10-year, or the Treasury bonds in general, what was the 10-year selling for back, over a year ago? 2.5, 2.8?
It was up probably 2.8, 2.9, even flirting with 3%. And as a practical matter, we're actually, when I say we, I mean my subscribers are playing an exchange-traded fund vehicle called TLT. And just last week, actually, we legged into a spread where we were buying call options with a late January expiration at the 126 strike. We've had a beautiful rally since then that's allowed us to short the 129 strike for the same price, 80 cents. So we've got on a $3 vertical spread with virtually no risk and a $4,800 potential upside.
When you talk about deflation, you're talking about debt destruction. The derivatives are a pile of debt bets. And you're thinking that they're going to keep this game going on for a while. They're going to do everything they can, and thus they're going to keep interest rates this crazy, below 2%. Is that the premise, or if it's not, tell me what it is.
Absolutely, and there's a kicker there for U.S. Debt paper in particular, and that is that if everything should start to unravel globally, the USA would still be perceived as the last man standing, and I think you'd have that flight to, I'm going to put the word quality in quotes, but we definitely have that safe haven status that would make treasuries a buy even if things go awry.
What about Christine Lagarde? She has been on repeatedly talking about this reset. And, there's China wants a piece of the action. They want the yuan, it's some sort of a world currency, reserve currency status. They're opening up these swaps all over the world, in almost every country in the world now. I mean, in Germany, in the UK, Los Angeles. And so what happens if they reset the dollar with the special drawing rights, the SDRs, and the dollar takes a big hit? Where do you stand on her reset? And, what are your tea leaves, showing you?
I think it's not even unlikely. I'd say it's impossible. You have to remember that the dollar is really the currency of choice for the big financial shell game that goes on. There's no other medium that will accommodate a quadrillion dollar game that the paper shufflers of all sorts play. And you also have to realize that it's an advantage to the whole world to be able to pay for something like oil in a medium, in a currency that's in infinite supply. So, if in the past there's been talk, that the Russians and even the Iranians would start selling us natural gas or oil on a hard money basis. But the truth is the world can't afford to pay hard money for things that it needs so much of as crude oil. So because the dollar is really locked in as the financial currency of choice for speculation, it's available in infinite supply, and we get to pay for real things with a dollar, of course, that intrinsically is probably worthless. So I'm not looking for any change in the dollar's reserve status. We're stuck with it.
Well, and then here's the next, because you're a big thinker, and I've been reading your stuff for a long time. I'm sorry I haven't had you on more, but I'm going to change that in 2015. But you're a big thinker. You have to think about the downside of a trade. I know you do. So here's my question to you. I mean, you say that we have this quadrillion, of derivative debt bets. We have, a ton of leverage in the system. It's the reserve currency is a flight to, quote, quality, end quote. And what could go wrong? What's your nightmare?
Well, it's interesting. One possible nightmare is unfolding under our eyes. It is the collapse in crude oil prices. And, there's the upside that shoppers are going to be getting to Walmart more frequently. But the much, much bigger picture is of a financial edifice that's very much leveraged to energy prices. And you can bet that if there's very conservatively estimated a $300 trillion derivatives bubble, I put it more at I use the BIS figure that's closer to a quadrillion, but in any case, there's so much of it out there that you have to consider what would happen if crude prices continue to go down. I've got a 31 target out for this year, and it's
stop. $31 a barrel target for crude oil for 2015.
Right.
Wow.
And it's impossible to predict what will happen, but that we saw the failure of a small bank in Cyprus, which was apparently a parking place for a lot of surreptitious Russian money. It nearly took down the whole system. So that was just a small piece of the leveraging that's come off energy prices, and Russia is not only hugely leveraged to it, but in some ways you might say they're criminally leveraged to it. So that's really the wild card. And but most any black swan event that I can see is deflationary rather than inflationary.
But a lot of people say, and I don't mean to interrupt you, although I did, I'm sorry. But a lot of people say, well, once they get into trouble, they'll print tons and tons and tons more money that will have, other people say this, that we'll have QE4 or some machination of QE4, that once they get into trouble, they'll turn the spigots back on and they'll print tons of money because they have to. It's a fiat system. It has to grow, exponentially. What do you say to those people?
Whenever I hear that phrase, they'll print plenty of money, it just doesn't, it falls flat. I don't believe in the idea. We printed plenty of money, and you'll see that it hasn't really done much for the working man. It has inflated the financial asset world hugely. You read about these IPO prices, a company like Uber that gets valued at $40 billion, just like that. Just a few months after it's valued at $1 billion, it climbs to $40 billion. So we've certainly pumped up asset prices, but it hasn't really done much for the real economy. And you understand from the what happened in 2007, 2008, we're actually going back to the dot-com craze. We're more pumped up right now than we were in dot-com times in terms of valuations. So there's a collapse out there somewhere, and whatever pumping they're going to do, it's not going to work. It's not as though the dollars get shoveled out of airplanes. They only work in the financial sphere, but they contribute nothing to the real economy. And let me say also that when you talk about priming the pumps and expanding the money supply, that does nothing to meet real bills that are hugely deflationary, including every pension plan that's offered by U.S. companies and by the U.S. government, that's where the rubber meets the road. It's real dollars, and we're not talking about real dollars when we discuss monetization.
And you're saying that that debt, those pensions, those are just big debt balls. The pensions are some future, you're paying somebody money out in a future thing, and there's not enough money to pay out the pensions. So you're saying that when you talk about deflation, you're talking about debt destruction. You're talking about bond destruction, pension destruction, things that just destroy, quote unquote, fiat money.
Right, and as I said, those expenses are hugely deflationary. They aggregate to numbers that we can't even begin to pay our way out of. So they're going to continue to impact on the economy. And yes, in theory, the government could monetize its own pension obligations. It could just basically say, okay, we're going to send a check to this pensioner, and his pension obligations will be paid. But you can see that at the state and local level, where they don't print money, it's impossible to do that. So those are sort of spring-loaded, not spring's the wrong word here, but they're essentially hugely deflationary forces in the pipeline. It's not like we're trying.
Look at Detroit. I mean, Detroit's your classic example.
Right, and Detroit I liken to Japan. It's only possible for this country to essentially take the blow of a Detroit because most of the rest of the country is fairly prosperous. And this was true for Japan. The only reason that Japan did not go under really with its deflation was that it was still exporting into a largely prosperous world. But who do we have to bail us out? What's going to help pump us up when all these back-end loaded obligations start to impact?
So you get the Treasury, you're talking at the 10-year, at 1.7 something percent interest rates, and not for a short while, for a long while. Oil, you're looking at 2015 oil at $31 a barrel. Where do you see gold, and where do you see silver? I mean, does that work in a deflationary scenario when debt is destroyed?
It doesn't. The most I've been able to tell my subscribers, who are very interested in gold and bullion, they're heavily weighted, is that no matter what happens, gold and silver will retain their purchasing power. But in nominal terms, certainly, it's not possible for gold and silver to do well in a deflationary environment. And I think that's been the primary impact on bullion since 2011 when it topped. Be that as it may, I've given an over-under number in my projections for 2015 and beyond. I lean a little bit toward an 810 target on COMEX gold, meaning it's going to come down a few hundred points. That's probably the worst I could see. But if something that I can't imagine right now happens that sends gold much higher, my target would be somewhere in the 1700s with an outside shot at around 2300.
So you're not, Harry Dent says gold could go down to 200, and he's a deflationist as well. And there are powerful deflationary forces. That is happening. But he says that gold could go to $250 to $400 an ounce, and you say?
I am willing to predict down to 810 because that's as far as my charts take me, but as far as refuting a $200 projection, no, I can't do that.
Okay. But you're thinking 810 is a bit. What about soft commodities? Like corn and beans and wheat and stuff like that. Does that stuff trade in a range, or are you captive to the annual or rain forecast or drought or whatever? Where do you stand on that?
Those are anomalous factors. We've seen seen them play out in spades in the coffee markets. And some of these super premium coffees are commanding close to $100 a pound. Weather is always going to be a factor, but I think that the weight of deflation will be heavy on the whole commodities complex.
Okay, and then and last question, 2015. Some people are predicting that this will be the year of another financial calamity. That it's really already touched off in the oil market. That the bonds with the shale market are heavily leveraged, and they got to pay some coupons. And when they start trying to pay coupons with $50 oil, that they they need $70 or $80 oil to make the payments. That the whole thing could unravel early in 2015. What do you say about the possibility of financial calamity, another financial mess in 2015?
Well, I think the collapse in energy prices is probably the most logical catalyst for such for a real crisis, and that it just sort of feeds into other things. We were talking earlier about the huge valuations in the tech sector. So we're definitely in a house of cards situation, and I haven't seen anything quite as obvious or as logical as the energy price collapse as far as what might produce that black swan. But on the other hand, there's been no shortage of things that you could inveight against a bull market over the last 5 or 6 years, and it just keeps going higher, and that is, of course, a function of global monetization that's going on. Some of it has to trickle into the markets, and that's what we're seeing. But, of course, the higher the prices go, the higher the averages go, the more money it takes to sustain it. So it's not a perpetual motion machine.
So how do you protect yourself? I mean, if you're talking about a house of cards that we see, a house of cards scenario, how are you telling your subscribers to protect themselves? I mean, if you don't lose your money and everybody else loses theirs, and you have gold and silver, isn't that a win?
Well, deflation is not really, it's not an opportunity. And we saw that the only guy who cashed out in the housing collapse was John Paulson. And it took an enormously complex financial structure to allow that. He had to go to Goldman and have them create essentially bettors to take the other side of his bet. So deleveraging does not really pose an opportunity for investors. And I think you're doing well if we deflate and you wind up with maybe 25% of your peak assets. If your net worth is 25% of what it was, you're doing pretty well. You only have to look at Warren Buffett to see where real safety is. These private equity funds are going into all sorts of bizarre deals, but Buffett is kind of sticking with the very basics. He's buying the railroads and the food chain, and you take a look at the things that he's done, cash cows like Geico. And you see that it's just when Buffett alone is in there swinging, what he's bought leaves the world of really safe investments pretty well picked over. I mean, he's got a lot of them himself. So in terms of my own subscribers, who, as I mentioned, love gold, I say if you're going to do it, if you absolutely have to own gold, and I really think you should. Then the bond hedge is a great way to go because, if we get this deflation, which is going to continue to weigh on gold, it's going to push your bonds up. And the bonds, as I mentioned, going way out, even 40 years on the yield curve with some of these education bonds, the bonds are hugely leveraged to capital gains that you might make over the next 12 months.
And so you say gold, bonds, interest rates lower. That's your projected 2015. Do you think that there'll be? Do you think we could have a calamity this year or not? Are you not thinking that we'll walk through 2015 and we'll go right into the election year and things will be good for the next couple of years?
It's always possible, and I've been saying the sky's about to fall for so long that I've become kind of bored with my own story. I sometimes look at the Martin Armstrong stuff. He's pretty popular with my own subscribers, and I have to say that he's one doomsday guy who was very patient. When he says it's all going to come tumbling down, he's usually projecting a cycle high that is years out, and there's a tendency in my guru business to say it could happen any time, and although it could, it's basically the stock market bull, the bull that began in March of 2009 has completely confounded my expectations.
Are you worried about brokerages going under? I mean, they are highly leveraged. They don't have a line of credit to the treasuries like FDIC and banks do. Are you worried about brokerages becoming some type of a series of MF global events where you just have your stuff hypothecated and you are not first in line for your own money?
That's one more house of cards, and just as we kid ourselves that the FDIC could bail anybody out in a real crisis, the same holds true for the brokerage industry. They're in a electronic, digitized world. There's no such thing as a stock certificate anymore. There actually used to be a $2 certificate you could buy for a call option. But anyway, we're way past that. And, SIPC offers retail investors some protection, but it's a matter of when three people are lined up at the first place on Wall Street to get their money back, it's all over for everybody.
Oh, that's not a very rousing endorsement of brokerages.
Well, it's true. It's true for the banks as well. If you go to your Wells Fargo branch and say, "Hey, I'd like to take out all my $25,000 in savings," forget it. The branch may keep no more than $20,000 to $30,000 at one time, so that again, if you've got two or three people lined up outside the door, they're not going to get anything back. And that's why I always tell my subscribers to keep a shoebox of 5s, 10s, and 20s, because if the stuff really hits the fan, that's the so-called the worthless dollar is going to be the coin of the realm. The guy at the gas station is not going to understand that your 1963 dime is, this is silver, you're going to say to him. And they'll say, well, I don't know about that. It looks like a dime to me. So in a real crisis where it takes time to sort out what's barterable, you should definitely have some 1s, 5s, and 10s and 20s, maybe a few hundreds in a closet.
Rick Ackerman, rickackerman.com. Thank you for joining us today on USA Watchdog.